This block here was horrible. We have a different solution, a contrast to see how when their development does their total gut and why you want to do a total gut. The historic buildings in West Baltimore. Great day. Welcome to the King Connections podcast. I'm your host, King. I'm joined by my guest, Larry King Paul. I like your nickname there, King, in the middle of that.
That's it.
How you doing today, brother?
Hey, man, I'm amazing as always, man. Excited to talk about how we're going to rebuild our communities, man.
Absolutely. So today we're going to focus on rebuilding we're going to talk about real estate investing. We got some key things. The core of our discussion today is now still a good time to invest in real estate. With today's market interest rates being what they are, where the housing market still continue to be speculated as it's going to continue to go down because of the interest rates are up. A lot of people not taking mortgages out. So a lot of people who are not familiar with real estate will use those as signals and signs to not get into real estate right now. And I'm going to give you my perspective why I differ from that, because it all comes down to your strategy. We're going to discuss strategy and philosophy, a couple of those key things on today's show. So with that being said, so brother, why don't you go ahead and lay out quickly kind of a brief bio of what you're doing in real estate to set the context of who you are and so folks can appreciate the skills you bring to the table.
Absolutely, man. So I started out owning my own personal property, right, buying my family home, and so it gave me an understanding of ownership, what to expect when you do own something and things like that. And so I've been working together with a group of professionals, and we're about to endeavor on a redevelopment project in Trenton, New Jersey, where we're going to put some affordable homes, some luxury homes in the downtown area. We plan on putting a new state-of-the-art community center for children, and we plan on having a sports bar nightclub. We haven't really decided on which way we're going to go with that, but we got 3 nice projects coming to Trenton to to kind of uplift that community a little bit.
Excellent. I love those kind of conversations, man. And now kind of lay out for some folks who may not be familiar with Trenton, kind of the economic situation. What I mean by that is Trenton a city that has a lot of blighted properties, because I know Baltimore City does, Detroit does. So kind of lay out the landscape of how Trenton looks.
Trenton falls in line with those same exact cities. If you were to look at our poverty rate, Trenton's poverty rate year to year normally falls between 28 and 32%. And so that's a pretty high poverty rate for any city. The city of Trenton owns about 60% of the property in the city. And that is not a good thing when you're trying to collect taxes on the city and things like that and reinvest in the community. If you own everything, you're not generating no income. You know what I mean? And so you got to kind of get that stuff out there. And so it's a lot of opportunity, but it's definitely blighted right now. There's almost not any block you can go down and where there's not an abandoned building or abandoned residential homes. And so me and my friends, we just got tired of seeing it. And we wanted to understand the process a little bit more. So, we got with some investors, and they kind of been showing us the process on how to attack a blighted community. And it's not just you do have to do it with money, but you have to connect with the people in the community. They got to know what's coming for them. They got to know how they're planned on being a part of it. It's a lot of different factors involved when you're trying to attack that, because of the activity that's going on in our communities as well, right?
Absolutely. I call it the energy. Yeah. Our communities have sometimes we got a lot of negative energy because people in survival mode, and they haven't been focused their attentions on thinking otherwise. You know what I mean?
Yes.
When you don't know better, you don't do better, you know what I'm saying, so to speak. Now, what I wanted to talk about, really kind of set the context for folks, is this. Today's interest rates and I'm gonna look those up real quick because I'm looking at a website right now, mortgagerates.com. And today's 30-year fixed mortgage is 7.416%.
Mm,
7.4% is if you're looking for a 30-year fixed mortgage. If again, for folks who want a 50-year fixed mortgage, you get it for 6.42, or
mm,
a 10-year 6 arm, 10 to 6 arm, you're looking at 6.85%. So bottom line is you're over 6% if you're looking for a mortgage in today's rates.
mm,
Now, what that means is that a lot of folks who are new to home buying, particularly Generation Z's who never looked at a mortgage rate before, and they were used to the mortgage rates the last 4 or 5 years coming after the recession.
mm,
This seems outlandish to them because the mortgage rate was like 3%, it even dropped down to 2%. So for them, they never experienced a 7% interest rate. And so this would be to them, they would tell, folks would tell them definitely don't buy a house right now.
mm,
And what I would say to this is this. What I would say to that is this is that I've been in real estate for over 30 years now. Brought my first house back in 19, actually, you say 19. That's interesting. Brought my first house back in 1998.
mm.
And interest rates at that time were 7%.
Phew.
Now that wasn't outlandish at that time. It was pretty much a norm. We were used to that. You were happy to get a 6% interest rate. That was something you were happy. You brought you could do what's in the mortgage industry called buy down. You can buy down your rate to a 6% interest rate. Now, the main thing an interest rate does for folks to understand is it limits your buying power, your spending power, because basically what it's saying is, like, for example, a mortgage at $150,000 mortgage at a 3% interest rate, you're looking at pretty much about maybe $1,100 a month mortgage payment. I'm talking about principal and interest, not the
Mm,
full penny payment of taxes and insurance, just principal and interest only.
mm,
Now, for a person who buying that same $150,000 house at 7.6% interest rate, you might actually be paying $1,800 a month.
mm,
Again, I'm throwing out this from the top of my head. I'm not using a calculator to really break down specifics. So I'm just giving you approximate so folks can get an understanding of the difference, how the interest rate can impact your ability to purchase. So now what does that mean? That means you're looking at a $700 a month difference roughly between a 2% interest rate and a 7.6 interest rate on the same purchase price of $150,000.
mm,
Now, again, some people will say, well, because of that, I'm not going to buy right now. I want to wait till interest rates go down. But see, here's the thing: when you think like a home buyer, and again, that is, you know, decent home buying experience, or should I say, that's decent home buying advice. But here's what I'll say to that: when you're buying a house, you want to be buying a house at a time where it's not in an ideal situation for a seller's market. So you don't want to buy in a seller's market; you want to buy in a buyer's market.
mhm,
Right now, we're really in a buyer's market because the sellers can't really sell because there's not a lot of buyers out there. And that's what determines the market conditions is demand. So right now, sellers can't sell. So if you're trying to buy when the interest rates are low, which it was, sellers pretty much that's a seller's market. A lot of people didn't were overbidding. So a
mhm,
house is $150,000, then someone come bid at 170, 180 because they can afford more. So now you're getting priced out of that market because it's a seller's market. And the seller sits back and they can determine the price of the house. So
mm,
this is a buyer's market. So that means that they're selling a house for $150,000 and there's not a lot of demand for it. So you might actually be able to get it for 130.
mhm,
Or I get that person to do what's called add a concession to it.
mhm,
And then so in other words, they may sell it to you for 140, but now they offer you a $10,000 on top of your down payment to cover your down payment as well because they really need to get the house sold. So
mhm,
this is why I say that regardless of the market, what's really important when it comes to real estate investing is having what I consider a key investor strategy, an investor mindset. You got to be clear on what your exit strategy is and why you get into real estate investing. Again, the show's not about home buyers. It's
mm,
understanding home buyers' demand and what triggers home buyers when they want to buy. But I'm not speaking to home buyers. I'm speaking to people who want to invest in real estate as a means. In other words, you're buying a property to make money.
mhm.
And whether you're going to make money on a monthly basis or you're going to make money down the road through appreciation and equity growth, then that becomes your strategy. But it's a mindset that you must have. But the mindset comes from understanding and reading and being clear on economics. So that's where I'm really alluding to. So for me, it's always a good time to buy real estate. It just
Mm.
depends on how you buy it.
Absolutely. I think it depends on where you are financially, right, in the situation. And I think it depends on how much risk you're willing to take on.
Hmm.
But a lot of it has to do with your strategy, right? Because one thing I learned is with real estate is up and down, up and down. And then you also have the power of refinance. A lot of people don't understand how to strategically use refinancing to the most capable, the maximum potential. But to be honest, man, that's how you get out of a bad interest rate that you might have gotten 5 years before, and you might be able to shave some years off your loan and make it cheaper at the same time. And so it all depends on where you're at. If you plan to hold the property for a long time, then I'll probably say look into refinance it. If you're not, then your exit strategy is, like you said, to sell, right? And so
Absolutely.
it's just all about what you're going to do with the property and who you plan on selling it to. But I'm with you, man. I don't think it's ever a bad time to invest in property because there's so many different ways to invest in property. And then we see it so much. We see so many rundown buildings. We see so many abandoned factories. And this is real estate that could be helping the community create jobs.
Absolutely. And absolutely. And to that point where I was getting at is real estate, whether you're going to make money in real estate or not, is always being able to understand the market cycles
Hmm.
and when's the best time to buy and when's the best time to sell.
Hmm.
And now, again, if you don't know real estate, you never invested in real estate, then yeah, it's definitely not a good time to get into the market. It's a good time to get knowledge
Hmm.
and really get yourself clear on what's causing that demand. Now, one of the things I love about what you're doing, Larry, is that, and this is why I advocate folks, that once you begin to understand economics a little bit, you can walk through neighborhoods, and this is where vision comes into play. A lot of our people don't have vision. And when I say our people, I mean folks who come from the community that we're talking about investing in.
Hmm.
So whether you're black or white, if you come from the community, sometimes you lack vision because you haven't seen how those communities can transform. Like, for example, one of the biggest education process I went through was I got into real estate again, like I said, 98. This is pre-housing boom in DC.
Hmm.
So I watched DC gentrify right before my eyes. Neighborhoods that had been blighted and had been run down and had been bad since the Martin Luther King riots. And people
Hmm.
said they would never turn. They were historically bad drug dens. You didn't live in that neighborhoods. You didn't go in those neighborhoods. Now those houses are selling for $800,000, $1 million, so on and
Hmm.
so forth, right? And I'm saying that because I've watched that change, and people who lack vision could only see a shell. They could only see a burned out house. They could only see a abandoned grocery store building, and
Hmm.
spray graffiti on it. Where
Hmm.
if you got a vision, you can see a strip mall. You can see a completed block of properties being renovated. You can see
Exactly.
grass growing. You can now bring economics to the community. Now, that's some of the things we want to talk about in today's show because that's what Larry's in the process of doing, which is why I wanted the brother on the show today because he's living that vision. He has a vision. And why don't you kind of share with people what's your vision for some of the work you're doing in Trenton?
Absolutely, man. When I start to do a little bit of research on cities like Baltimore and Trenton, we have a few similar issues, which is unemployment rate tends to be a little bit higher, homeless rate tends to be a little bit higher, and when I start to look at what are the best ways to employ people and get high infusions of cash in an area, I don't see any other way that would be better than real estate. I mean, government contracting absolutely helps you do cash infusions, but real estate at the same time allows you to rebuild and transform communities. Also, it really makes you understand team building, because in order to rebuild a community, It takes more than somebody who understands economics. It takes more than an architect. It takes more than a construction company. It takes all of us. And it really forces you to work well with others to complete a goal that's going to benefit everybody. There's the planners, there's the people who gotta really institute the strategy and managers, and then you have the workers. And so based on where you are, we're really trying to make sure that we stimulate our economies by giving people who need these jobs and these opportunities a better opportunity, right? And so that's what it all comes down to. Understanding when you get a project and you hear these projects say it's $200 million project, or it's a $40 million project, or whatever the number is. I think the first thing the people in the community should be thinking about is they have to spend that money to hire people. They have to spend that money to do work. And then you should be thinking, what can I do to work? Am I a photographer? Because I can take pictures to show the progress of the job. Am I an accountant? Because I can help track the finances to keep them as transparent as possible. It's a lot of different roles you could play on this. But if you think this company is here to regentrify us and they're not going to do anything for the community, it's always a person of a specific culture that owns this, then we're going to always keep running into the same problems. And so I always feel like if you want to change something, you have to be that. And I think it's important for our community to see people that look like us heading redevelopment projects in our community. It'll give them a different way to think about gentrification, because gentrification can be bad, but if you're a part of it, it could be good.
Absolutely. Absolutely. And see, that's where you got to understand economics. When you understand economics, you realize that it's not so much about race as it is about knowledge. What I mean by that is those who don't have the knowledge are not going to win in an economic war, right? Because you just don't know what moves to make. You don't know why those moves are big. You don't know what creates market demand, market cycles. You don't realize that real estate goes in cycles. A lot of people don't realize that, and it goes in cycles pretty much every 7 to 10 years, depending on if something major happens. It can be reduced to 2 or 3 years. That's where it becomes catastrophic. I could show folks, man, back, and I used to, and they stopped putting this kind of data on their website for whatever reason. But the housing HUD used to show that interest rates per state per year. I'm sorry, appreciation rates per state and per year. Because here's the thing that a lot of folks don't realize, that when you talk about appreciation, again, appreciation is the difference between when your property market value, your note of your property, your loan, and then the market value. It creates the equity. Appreciation creates equity in that context. So if you're averaging, and the appreciation is measured in percentage. So if you're averaging a 6% appreciation for 10 years, then your property will double in its value. So in other words, if you buy a house in 2000 for $150,000, by 2010, the house is going to be worth $300,000 if it averages a 6% appreciation over that 10-year period of time. And again, I'm not speaking of every year it has to be 6%. Some years it could be 7%. Some years it could be 4%. I'm saying a 10% average a 6% average over that 10-year period of time. Now, what drives me is understanding that when you want to build wealth, then you want to buy real estate from an equity growth context. Because yes, you can buy a property and you can fix it up. You can buy a property, for example, for $30,000. Now, again, I don't know Trenton's market, but I know in Baltimore, we can buy properties for $30,000. We could put $60,000. Now, some people will put less. I say 60 because I have a set structure of what has to go into each house that we feel comfortable with selling. So in other words, we're going to replace it. We're going to upgrade the kitchen. We're going to upgrade the bathrooms. We're going to change the roof, whether it needs to be or not, especially if a house has over 10 years old. We're changing the roof. We're putting new mechanics in the house, right? So once you begin to do all those standard things, then our budget for each house is roughly around $60,000. Okay. So again, just using the math, we buy a house for 30, we put 60 in it. So now we're at 90. Now, we're not going to get too complicated with the scenario because, again, you got to borrow money. So you got to add points and all that. But let's just say we're at $90,000. Now, we want to sell the house for at least 160 to make it worth our time.
Yeah.
Right? Because again, you got to have seller concessions. Sometimes you might have to pay in this kind of market. You do have to pay a buyer's down payment and closing costs sometimes. So if you're selling for 160, that might be you putting down a good 6% towards that. So you got to add some thousands, maybe $7,000 toward that. So you want to be able to walk away with about $40,000, $30,000 minimum from your investment of time and effort. You should never approach a project when you're going to make less than $30,000 unless you're being mentored on it and you really want the experience. And you just really want to go through the process and say, I've never done a renovation before. I just really want to learn. So even if I break even, I learn because it's an education process.
That's it.
But once you've been educated and you're clear on kind of how you're taking a completed renovation project from start to finish, then you really want to be at a $30,000 kind of determine whether or not I'm going to pull the trigger on this particular property. Now, again, that's cash flow, right? I mean, that's making money quickly. So you make that $30,000, and as you know, you're a CFO or you work in accounting and you understand finance, you got to pay taxes on that.
Absolutely.
And what's the tax rate a person was going to pay if they've made a $30,000 profit of a property like that?
That's a lower tax rate. Normally your tax rate will fall if it's $30,000, you're gonna fall in like the 27% tax bracket. It starts to be if you start going up, about every $20,000 up to like 250,000, then you get in the 39.5. But at the lower end, like 30,000 profit, it's normally in the 20s. Once you start getting close to $100,000 a year, then they start taxing you 30%, and then it goes up and up until 250. They take in close to 40%, 39.7. So you got it. You definitely this. So what's one thing I learned, and you were talking about construction strategy, right? Development strategy, and this is why a lot of the contractors, even Trump, one of his strategies was purchase property at the end of the year, going back into the business, so the gain that you gain off of selling that property is not as high, so you don't have as much of a tax burden. All right, so if you reinvest, so if I sell property and then I purchase property in the same year, what I purchased can go against what I made. And so that lowers your tax burden. And this is something that I learned from Donald Trump. At the beginning of the year, that's when you want to inflate that's when you want to kind of get your construction and things done, and you want to try to get your people who come out there and do your price adjusting. You want to have them come out there and evaluate your property, and that's when you want to get the highest amounts, sell your stuff, and then throughout the course of the year, you want to purchase up your strategic buying points. And so by the end of the year, you did most of your buying towards the end of the year, and it should lower your tax burden for that year, and you kind of go back into that cycle. Like you said, it's certain people in this industry have cycles, strategic cycles, and that's just one of them that I learned from Donald Trump.
That's Donald Trump actually, a lot of people make jokes about him and call him a fraud, but he had some pretty good books on real estate and business that were put out. Now he didn't write it; his name and brand would add it to him. But I learned quite a bit of information from those books, and that's why I say, you came throughout, and it's an expression that people use over and over again. You can't throw the baby out with the bath water. That's true as relates to even Donald Trump. You know what I mean? But what I want to show folks right now is this graphic, and it's called the investment philosophy. Now, what I did was I created this for clients of mine because when I sit down with people who really want to get in real estate investing, a lot of people just want to get in real estate investing and they're not clear on what their goal is, or they don't have a clear investment philosophy. And when you don't have a clear investment philosophy, then what you're going to end up doing is buying a house because someone told you that's a good house to buy. And I can't even count. It had to be at least 20 to 30 people I've talked to over my lifetime that have bought a house because a friend of theirs told them to buy it. They started with the renovation process, didn't understand how to work with contractors, got overpriced on that part of the process, and wasn't clear on how to sell the house once the property was done. So they lost a lot of money, became frustrated, and end up having to file bankruptcy of their first investment deal. So this is why I tell people, before you even begin to think about purchasing your first real estate investment property, have a clear understanding of what your investment philosophy is. And what I'm showing folks going from top to bottom is this. So the first question I ask you is, what's your investment purpose? So I got on one end of the scale from the left side saying cash flow. So you want 100% cash flow, which means that you're paying, let's say, for example, your monthly note on the property, your debt load on the property is $1,000 a month, but you're able to rent the property out for $1,500 a month. Then you generate that $500 a month gross cash flow. Again, I say gross because you got to look at things such as maintenance and all those things, taxes, marketing, where before you can get to net. And we're not talking about net right now. We're going to talk about just gross. So your monthly cash flow is $500 a month. So that's great, right? But again, as you just heard, cash flow requires you got to pay taxes on cash flow. So then the other side of the spectrum, the right side completely is 100% toward equity growth. That means you buy a house for that $150,000. You wait 10 years, you get 6% interest appreciation rate. Now it's worth $300,000 because it doubled over that 10 years, and you got $150,000 worth of equity growth. And that's really where you build wealth. So what I get folks to understand, be clear on your investment purpose. Where do you fall? And again, this investment philosophy is not locked in for the rest of your life. It just gets you started so you can be guided toward the right decisions based on where you are. And as you mentioned, the second thing is risk level. Are you 100% conservative, which means you don't want to lose no money? Now, nobody wants to lose money. But realistically, if you're investing, the risk of you putting money out there is there. So where are you? Are you aggressive? I'm a more of an aggressive type of investor where I'm willing to take some risks with my capital, right? So where do you fit into that scenario? Then you got deal preference. You want single family houses, or do you really want commercial buildings, right? So people got to be clear on that. You can't just let the deal drag you to where you to spend your money. You got to really think through what your investment philosophy and stay locked in. Exit strategy. You're going to renovate and sell. Is that the reason you're buying a property, to renovate and sell it? Some people call that term flipping. I don't like the term flipping because flipping devalues the renovation process. Some people, you can just put a coat of paint and some carpet. That's a flip. We want to bring quality to the renovations that we do. So I say renovate, sell. So I want to be clear on that part. Or you want to buy and rent, which is now you're generating cash flow on a monthly basis. And then you want to hold on to it for the appreciation. You can achieve both. Area preference. Are you only interested in your local real estate market? Or are you willing to even go international with it? Like I'm looking to buy a property in Brazil, so that determines that. Management preference. This is a key thing that a lot of new investors don't really get, and they gotta be careful about, which is, are you going to be a landlord once you buy the property, or are you going to rent it out? Or are you going to hire a management company to manage your property? I highly recommend on the first 2 or 3 deals that you become a landlord just to learn it, because now when you do hire a management company, you know what to look for and how better to evaluate those individuals, as opposed to just starting off from scratch and not knowing what it takes to manage a property, and then the management company pretty much taking advantage of you. Because see, one thing I would say about real estate that's a given, and that is this: real estate is a business that preys on your ignorance. If you don't know what you're doing in real estate, you get taken advantage of at every level. It breeds taking advantage of people, from the real estate agents to the contractors to the investors to the hard money lenders to the, whoever you're working with. They're going to take advantage of your ignorance when they smell you coming. And then finally, investment presence, low income, meaning that you like to buy in low income neighborhoods. And there's a pros and cons for that, obviously. And then there's a high income neighborhoods, and there's pros and cons. And then there's a middle income. So this is just a walk through, just get some initial things down to say, here's what I'm looking for. Here's what's important to me. That way you can be guided toward the right deal and reduce the risk of you buying a property and then just being over your head and not knowing what you're getting into.
I love this little because it's very simple, and it honestly, if you're consulting for somebody or just really just trying to help somebody just getting out into it, you're really going to help give them some guidance and direction with just these little 7 touch points. You know what I mean? So I think this is awesome. I also think, like, when I look at something like risk level, right? There are certain times where I think risk level has a bunch of different variables. The biggest one is age. If you're younger, you should absolutely be more aggressive, because you being aggressive will allot you the better rewards, and you have more time to make up for mistakes if things don't go great, right? So I always tell people, if you're younger, you have the opportunity to be more aggressive. But when you pay attention to politics and you see everything that Joe Biden is doing for infrastructure,
Mhm.
which falls into construction, which falls into building. We have so many things that is making this not as risky as people may think it is. That it's funny that some people even see it as risk. It's just more so about having a plan. I think most people think, a lot of money, I can get it done, and that sounds good. But if you don't have a plan to follow, that's when things get more risky than they have to be. And so I think actually understanding your plan, and that's what I've learned from working, um, you know, in real estate, and with people who I have partners who are in real estate and things like that, and we conversate. And one of those things is, man, if you don't know, it really is going to cost you, and it's worth it to just reach out to somebody like you, King, and pay them for the information, instead of going about it without knowing, and then now you're making a $1 million mistake. You know what I mean? And it's also going to set you back with reputation. So, I think this forum you have right here is really amazing, because it's going to save a lot of people a lot of time, and it's going to make them think about things they didn't think. When I first bought my house, I did not think about exit strategy. I was doing what the most of the masses do. I was in a financial position to purchase my house, and I purchased my house. I didn't think of, am I going to keep it for 30 years? Am I going to sell it for 10? I just more so like the house, got the house. And that's good. That was fun. I got my house, right? But it when later on, when questions started arising, right? Because I bought my house right before COVID. So in the first 2 years of owning my house, it doubled in value. So I'm
Mhm.
talking with my wife, and she's like, I want to live here forever. And I'm like, baby, our value to double. We don't got to stay here, right? And so
Right.
if we would have talked about exit strategy earlier, we'd have been better prepared for those conversations and been more able to align with that. You know what I mean? And so I'm just looking at this, and I think it's amazing. Um, I do think the way I've seen a lot of ways out of poverty for our community. When it comes to trucking, when it comes to government contracting, and a whole different ways where people can make money with multiple people and a lot of it. But there's nothing more lucrative than real estate. You know?
Absolutely. Absolutely. I tell, and you can correct me on this, but I tell folks this, that real estate is one of the only few investments that I know of that you can actually borrow 97% of the purchase price of the item you're purchasing, your investment. You can borrow 97% of it, or actually
And
96.5,
in
which
certain
means
cases, you can borrow 100% now.
right.
You know,
And that's
and
the only you can't go get stock and get 100% loan on your stock investment.
absolutely not.
You can't buy diamonds and gold and get 100% stock, get 100% loan on that diamond or that stock investment or any kind of commodity investment. So this is why I say real estate, and another benefit of real estate that I love is that it's tangible,
That's
meaning that if you do buy it as investment property, you can actually go drive by it and see and look at it every single day.
Yep.
That's my property I own right there. Right now, again, there's some cons to it, and that's where the education comes into play. And this is what I tell folks, and this is in business in general, but it's really key in real estate. You cannot, or you should not invest in real estate without some form of mentor.
Mm,
And a lot of people don't want to do that. They feel that a mentor is going to charge them money, which a mentor should charge you money. That's their time, right? And they don't want to
absolutely.
pay. But here's what I've learned, and I've learned this the hard way. And I'm sure that anyone who's been in real estate for over 5 or 10 years, at least through one housing cycle, they have a real estate horror story to tell you of
Hmm.
how they brought something wrong, or the market changed, or something happened and they lost money on that deal. Everyone has them. And so you can't avoid them. I haven't met anyone who can tell me they've been in real estate for 10 years and they just made money on every single deal and they never lost any money.
Mm. No, honestly, it's but number one. a lot of people get in with what they just learned and then they go from there, right? And so that's normally why a lot of people lose money, because when you understand this entire system, um, see, people lose money when they don't have enough partners. And that's one thing about construction. Or redevelopment, whatever part of it you're getting into. But you really got to have a strong team of people who can execute things, man. And I mean, it's nothing that will make this process easier for you than that. Having lawyers you can trust, having architects, engineers. There's so many things, and that's why it's so lucrative. The job is to split it up and to get everybody moving. You know what I mean? Once I pay my architect, he has to start drawing, he has to start designing. Once I pay my engineer, he got to get on CAD, he got to start designing. You know what I mean? Once I pay the construction guys, they got to go to work. And so that's why I love construction too, because when you invest in stock, you're not really doing nothing. But when you invest in real estate, people are moving. You know what I mean?
Absolutely.
People are doing work, getting things done. And to me, I've made money a bunch of different ways, and I look at investing as I my definition for investing is putting money here now to make more money later. And there is a bunch of places that you can do that in. But the smartest way to invest is to invest in a business that has good business principles and structure. That's why
Absolutely.
everybody likes to invest in Apple and Amazon. It's not just because those companies are successful, but those companies are successful because they have good systems and business practices. And so when you understand what investing is, oh man, it makes things like this so much easier, man, because most people want to invest their money now. Now, what scares people from this is the loss. Oh, I don't want to take a loss. Most people only lose out on investing when they quit. When they
Right.
quit. If you keep going, it's almost impossible to. The government is investing in real estate. They come out with HUD grants, and oh my gosh, so I'm doing this project in Trenton. HUD has a grant where if you fall short on your construction costs, they will influx up to $5 million on in your project if your project is worth more than $10 million to
Actually,
help you.
say that again, brother, so folks can really get a understanding for people who may have missed that.
Absolutely. I'm gonna say it a little bit slower. So HUD has a program, and I actually wanna reference the name of the program for you. Because there's four that I specifically are working on right now. And so it's called the Construction Inflation Fund. And the Construction Inflation Fund is the government knows everything is going up recently, right? Costs,
Right.
even groceries, everything is going up. So if you are in the middle of a construction deal and let's say your financing has run out and you don't have the money to can finish your construction loan, you can literally go to the construction inflation fund in your state, and they would be able to give you up to $5 million as long as the project costs more than $10 million. So if the
Wow.
project is $10 million, they will come in and cover up to $5 million of those costs. And as long as you spend it on construction, it is a grant. It is not a loan. So you don't even have to pay that money back because it's to stimulate the economy. When they give you that grant for the construction, all you're going to do is pay people to work with it.
Right.
You know what I mean? And so you just got to understand why we have money and why it's so lucrative. We only get a lot of money to help people pay to go to work, you know? And
Absolutely.
and so
Absolutely.
yeah, man. So we got a
That's
lot of
powerful,
safety
man.
net.
That's
Hey man,
powerful.
I feel like not just knowing information is important, but being able to articulate it and share it is of utmost importance. I need people in Philadelphia and Chicago and Detroit to understand these programs are here, and we have lenders who are willing to lend to you 100% because we specialize in these communities. So
That's excellent.
you know what I mean? There is no guide in Trenton who can explain this better than me. And so when an investor comes and they say, okay, I want to invest in Trenton, I am one of the best guides there. So yes, they do what if you have capital, it's always best because then you're going to have more equity, you're going to own stuff, loan terms are shorter. But I don't want money to be a reason why our people are not participating, you know?
Absolutely. Absolutely.
Yeah.
Absolutely. Well, I'll tell you what, man, if you wouldn't mind doing this, because for individuals who actually email me at info@consciousrt.com, that's info at conscious, ConsciousRT as in roundtable.com, then what I'll do is you can send me links to some of those articles that you sent that you mentioned.
Mm-hmm.
That, and we're going to also share your contact information for folks who want to get in contact with you as well about investing in Trenton, because I believe what you're laying out is clear. And to some of the things you said earlier, I just wanted to bring up this graphic because I create this graphic to show individuals that when you're really going to get into real estate, and I'm an engineer, I'm a system engineer by training, so I'm always thinking processes, I'm also thinking structure, and so for me, what I understand is that you need a team of individuals if you're really going to turn this into a real estate investing business. Now, if you're just in the hobby of real estate investing, you want to buy a house here and there, that's a different mindset. But I'm saying you really want to turn this into a business that you're doing and you're spending most of your time towards this business, then you need a team of individuals to work with you. And so I'm going to show you this graphic. I'm going to show another graphic of, well, two more graphics before we depart, but I really want to show who you need to have on your team.
Mm.
So basically, you want to have a realtor, and you want to have a real estate investment knowledgeable realtor, not just a realtor who knows how to sell a house. That's a different line of thinking. I
Yes.
can tell you right now, somebody can be a real estate agent for years, 20, 30 years. If they've never purchased or worked with a real estate investor, they don't understand how investors think. They have an excellent understanding of the market conditions and all that, working with home buyers and sellers, but they don't understand what's important to investors, then they're not going to be very helpful.
Mm.
Number two, you're going to need a deal evaluator. This is somebody who is going to help you understand how to lay out the terms financially of your deal. So that's going to be key. Like Donald Trump is not someone who goes through neighborhoods and when he decides to buy a house or buy a building, he's not looking at it himself. He has a team of individuals that bring deals to him based on the understanding of what his preferences are,
Mm.
right? You need a connector, someone who actually can connect you to multiple resources and have affiliations with the city officials, like you just said in Trenton. Now, you're a connector in that context.
Mm-hmm.
So someone coming and getting connected with you saves them a lot of time and can save them a lot of money that they didn't have you and they were trying to buy and go and navigate through Trenton where they would go wrong.
And can I just before you go on to the next one, for anybody listening, a great connector in most of our cities is the local city planner. The city normally has about 4 of them on staff. You can go right to your local city website and see who the city planners are, and those are great people to start with connectors because they normally know all the other trades in their city. Before you start big projects, you have to go through planning and zoning, and you have to get approved to do this stuff. And one thing I learned that is the city planners tend to be very good at connecting you to the services you might not have on board yet. So if you don't have a connector, your local city planner is a great place to start.
Thank you for adding that tip. Absolutely. Absolutely. Need a salesperson, customer service representative. I'm going to go to the rest of these pretty quickly because I just want folks to really just get a snapshot right now that you need a team. And then different shows, I can go in depth on each one. A contractor, obviously, you need a contractor who understands. And again, what I'm pointing out real quick, I'm just not going to do this for each one, but I just really want to point this out on the contractor. Certain what I consider quality characteristics and description, the mindset. So you see a contractor, a key description is he's a hard worker. That's important. I know a lot of contractors who are very competent at what they do. They can be excellent plumbers,
Mm,
excellent carpenters, excellent painters, excellent roofers, but they're not hard workers. In other words, they get enough money in their pocket for the day. They're not showing up for their project the next day. So that's why I'm saying then that gets into the reliability aspect as far as the key characteristic. And then the mindset has to be quality. I want a contractor who really believes in the quality of their work and not just focus on trying to leverage money from one job to the next job because they're in survival mode. And that's where most people go wrong when they're hiring contractors is not understanding the contractor's mindset and then trying to go for the lowest amount of money possible when it comes to paying a contractor. And I can
mm,
tell you right now, that's not the way. I'm going to show a graphic in a second how you
mhm.
determine how to choose. It's called a contractor triangle, decision triangle.
That's it, man. And I think anybody, on a construction project, you're gonna have multiple contractors, right? You normally have a general contractor who's overseeing all the other contractors, right? Like all the other trades and stuff. But you want to make sure your contractors also have a general knowledge of different things that's going on. And I'm more so specifically talking about your foreman or your general contractor on a project. You want to make sure they understand electrical, plumbing, HVAC. They don't have to be a specialist in it, but they got to know a generalized understanding of all of it, because you're going to have different trades coming in, but you need that person who is representing you in the build to know everything, a little bit of everything that's going on. So when you get that head foreman, that head general contractor for your project, aside from being a hard worker, make sure they're pretty well rounded, because that's very important for your general contractor.
Absolutely, absolutely. Financial analysis, social media manager, investor with somebody who has investment money experience, and then of course you want an attorney to help you, because in this business people can sue you whether you're in the wrong or not. They can sue you just because they want to sue you, and you have to go to court, and have an attorney on hand and understands who you are in your business operations is critical, as opposed to going out and getting an attorney when you need one. That's a different conversation. And I've been in both situations, and I'm telling you, having one on hand who understands me is much better than going to get one when I need one, and having that anxiety and the uncertainty of how to hire an attorney, and I need the quickness of hiring an attorney, and is that person qualified. So that's a whole other conversation. So this is a quick snapshot of your real estate investment team. I'm going to show you quick um, two more quick graphics to illustrate my point of working with contractors. And to your point about how to go about determining how to hire a contractor. So here's a slide which I consider to be the 12. Now, I made this relevant to Baltimore City. It could be more relevant to any city. You pretty much just change Baltimore City. But 12 major questions I ask when interviewing contractors, right? I'm not going to read all 12 questions for lack of time, but I just wanted to show you that, again, there's a process that I use when it comes to working with individuals that I bring on my team. You have to interview them because you are, at that essence, you're the employer, and they're going to be working for you. So you want to have interviewing questions. How many renovations have you completed in Baltimore City? That's a very important one. The reason I say that is because I've met folks who've done the renovations, and contractors who did the renovations in DC. Some folks have come down from New York, but they come in Baltimore City, they get stuck because it's a
Mm-hmm.
different animal, right? The landscape of the city you're operating with. Are you licensed and bonded and insured? How many shells have you renovated? Because a person can definitely be a person who renovates single family houses in the suburbs, but they
Mm-hmm.
never renovated a shell, and that's a whole different animal as well. So you got to be
Mm-hmm.
completed with that. And then here's some other questions: where you obtain the required permits and inspections for the project? Are they expecting you to do it? In other words, to your point about a GC would do that. GC is going to be a little more expensive, but that's one of the reasons why you want to have a GC, being general contractor, and when you provide a project schedule with a timeline and payment draw schedule. So those are some of the key 12. Those are 12 questions. Again, I send it to individuals who really want a copy of this, so you can begin to look at this, how you can begin to work with these contractors. And I want to show you one more graphic before we get ready to close. And that's a graphic which I feel is an important graphic when it comes to determining how you go about bringing contractors on. And that is what I consider to be the decision-making process of contractors. And give me 1 second, I'll bring that up.
Yeah, no, these are amazing graphics, by the way, King. For anybody looking to get into real estate investing, please reach out and make sure you grab these graphics.
Now, this graphic is the contractor decision-making decision triangle. Because see, here's what I realized from my experience working with contractors over the year is that you got to determine which is the most important tool you're going to get. You're not getting all three, right? In other words, you want quality, great. Everybody wants quality. You want it done fast, excellent. Then it's not going to be inexpensive, right? That's just not, you're not getting all three. It's not going to happen. Now let's flip it. Let's say you want to save money. You want it to be inexpensive and you want it done fast, then you're going to lose out on quality. And then finally, let's say you want it done inexpensively, and you want great quality, then it's not going to be done fast. So you're not getting all three, which you got to determine for you which of the two are most important. Now, for me, what's most important for me is the time and the quality. Money can always be made back on how you structure the deal. And like I said, my investment strategy is always about equity growth. So I'm not looking to make all my money right then when I close a deal. I
Hmm.
want my money can be made over time. But I definitely want it to be done at a time that's estimated properly. And I want the quality to be outstanding. And that's what's important to me. So this is something I just want to help people guide them through, because a contractor, here's a key way a contractor knows they're dealing with an experienced investor or an unexperienced investor. When you walk through a property and you ask the contractor, soon you walk in, how much is going to cost to renovate this house? The contractor already knows you don't know what you're doing,
Hmm.
and they're going to be like, wow, are you giving me that kind of question? Then they're going to be able to throw in their ability to go to Home Depot, and you got to determine whether you're going to pick up this parts and supplies, or you let the contractor pick up the parts and supplies. All that has to be determined. But what I'm getting at is a contractor who knows they're dealing with an experienced investor would sit here and say, an investor would say, here's a scope of work. Here's how much I want done on the kitchen. Here's what I want done for the bathrooms. Here's what I want done for the bedrooms. Here's what I've done for, I want done on the roof. And the contractor can look at your scope of work and then make a determination based off that. And they price each area. And you're saying, I already know what the parts cost. Just give me your labor rate for each of these areas. And so that's where it becomes a different conversation that you're having with the contractor, as opposed to this contractor, they're trying to determine his labor rate plus the supplies and plus trying to give you an estimate of how much a house is going to cost through the renovation. So I just
Got
want to share this with individuals so they can kind of realize there's always a process when you're hiring individuals. And if you follow the process, then you definitely reduce the risk of you losing money and, of course, a lot of money at the same time.
Absolutely. And just to reference that one time, I think the only time you run into trouble on a construction project is when you try to prioritize money in the project.
Mhm.
Money is the result of you running a successful project. And the faster you run it, the more capital you'll have left over. A lot of people don't understand that at the beginning of a development, you're given estimations. You're given a plan that everybody is planning to stick to. But just like in any business, if you supersede that plan, time will save you guys money. There tends to be bonuses involved, and the developer and the investors tend to get the best of that. And so I think it's really important when we say real estate, we need to explain there's so many lucrative positions in real estate that some people don't even deal with owning the property. I ran into a national broker, and what she does is she has a relationship with a bunch of different banks around the country. And when you need a loan on a project or a bridge loan or something like that, she's there to connect you with money. That's her job, to help people who are don't have enough capital for projects to find the capital that they need. So research real estate and see how many different ways you can be a part of this and help people be a part of this, because this is the most lucrative thing that is out there, because it's the biggest thing that helps people. If you're homeless, if you need shelter, if you're in a community that's run down, when you get a revitalized community, when you get a rebuilt community, it changes the whole nature in that community. It changes the emotional state of everybody. And so construction is not just a job, it is also a feel good. When you walk down the street and you see a new building in your neighborhood, you feel a little bit better about that. Same thing as if you see an old park and you see a new park, you feel a little bit better about that. So construction isn't just about money, because it is very lucrative, but it also, when it's completed, it makes people feel a whole lot better about where they live.
Absolutely, absolutely. And like I said, man, you bring vision to your point, having the connections. That's where you see I'm advocating my connecting with intent formula, strategy plus connections plus systems plus value equals capital. Social capital brings the financial capital component. Having people who can be a part of your team who has experience with renovating properties, with raising capital, with working with the local utilities. Another big thing that a lot of people don't counter is, what's the timeline with utilities being turned on when you're doing renovations. We got BG&E in our area. If you
Mm,
don't have a great relationship with BG&E, they can stall you out for months. And
mm,
that holds up your ability to move on to the next level of the draw schedule. If you're getting a draw from your hard money lender or your
yep.
lender because you can't get the inspection done because you need the utilities turned on and BG&E is backed up. And they're telling you right now they can't come out for a month or two.
Mm,
And you got to factor that into your thinking and your planning before you even begin your construction project to understand what are some of the challenges they're dealing with. This is why connections are so important.
yep. If you are not well connected, you should wait and think about entering into real estate. And if you aren't well connected and you want to get into real estate, just start going and meeting everybody that's involved. I don't want to discourage you. I just want you to have the right mindset. This is not a I'm not a people's person industry. If you're going to be in this industry, you got to know people. You got to know real estate agents. You got to know lawyers and accountants. And these things you shouldn't be for dread and learning and meeting these people. They're going to help you learn different parts of your life. Lawyers help protect your assets. If you start making more money, you need to have way more conversations with that lawyer than just about construction, right? And so once you start understanding money is the result of doing good things for people, and you understand construction is one of the best things you can do for a lot of people, then it's really easy to understand how you make the money. But most of the money doesn't go to one person, it goes to the entire team. And for the developers or the people who invest the most, they normally don't get paid until the end. And this is I like to clear up ideas. A lot of people think people come in gentrified cities and they're billion-dollar tycoons and they're just buying up the city. And a lot of the times it could, I mean, sometimes that could be the case, but a lot of the times that is not the case. You know what I mean? And so we really have to break down the real estate cycle so people can have a more positive outlook on the people doing the real estate in their area. If you do have a big real estate company in your area, reach out to them, man, and see if they'll tell you about some of the things that they're working on. See if they'll tell you, because most of the time the big guys don't think the little guys are competing with them anyway. You know what I mean? And so
Mm,
they don't mind sharing information, but if you don't reach out, you'll never get it. So reach out and get involved, man. Get involved.
absolutely, absolutely. Food for thought. Powerful words. Thank you for sharing that, brother.
No
Appreciate
problem.
your, energy, investment of time, and joining us today. You shared some words of wisdom. Please share your contact information. Anybody want to reach out to you and get some things going in Trenton.
Absolutely, man. You can catch me at Larry Paul at royaltyfinancialservices.net. That's my email address. And then on our social media, Royalty Financial Services, you can find us on Facebook and Instagram. But if you want to get more involved with helping your community, I would definitely implore you guys to link up with my charity. That's Culture Change. You can find us on Facebook at Culture Change 2020. Same thing on Instagram, Culture Change 2020, and we should pop right up. But it's not just about rebuilding in our community; it's about creating a new level of unity in our community, and that's kind of what our culture has been lacking over the last 20, 30 years. We have certain people who do it, but we need the entire community to get into the unity, man. So Royalty Financial Services, Culture Change 2020, Instagram, Facebook, all your social medias. Check us out.
Absolutely. And for those who are more interested and continue to learn more about what we're building here, with again advocating for knowledge over action first, real estate is definitely get your knowledge, do some reading, have a plan, strategy, get your connections, build your systems, all that, and then focus on creating value, and you're going to get access to capital. So keep that in mind, folks. Thank you all for listening to another episode of Connecting with Intent and the Conscious Roundtable, Conscious Baltimore Movement Mission. Thank you all for listening. Until next week, everyone have a blessed and productive day. Thank you again, Larry, for joining us.